In today's video, I am going to be talking about the big six banks in Canada and which one is the best investment right now. Basically, we're going to go over all six and then we're going to make a conclusion at the end. So let's get down and let's check out these amazing stocks. So first is National Bank, and technically one of the cheapest banks in Canada right now. Its PE ratio is the lowest out of the big six at 10.47 at the time of making this video. Now that is important because of course that is the price to earnings. And the lower that number, the cheaper that bank technically, or that stock technically is. The average volume is 1.5 million shares traded on average every single day, so it's very easy to get in and out of. And when it comes to volume, the higher the volume is, the more shares that are getting traded. And when that is the case, unless you're trading in this case over like 750,000 shares in one sitting, you really shouldn't have all that many issues trying to get in and out of it. And of course, the dividend for this stock right now over the past years, 3.51%. Over the past 5 years, it's actually had one of the best charts as well when it comes to the Canadian banks. Most of the banks were trading essentially sideways over that same period of time before the virus. However, we had seen growth during that time as well when it comes to National Bank. It actually spiked right before the downturn of the virus. However, since the virus, it has exploded to the upside, and since then it has been trading sideways. They do tend to raise their dividend about once per year. However, we do need to really focus in on the most recent dividend, and that is, of course, the recent December dividend of 87 cents per share. Why is that important? Well, we have seen that this bank and all other banks in Canada were unable to raise their dividend during the virus. They were not allowed. However, when we zoom out, we can see that before the virus, they raised their dividend by 3 cents. They raised their dividend beforehand by, again, 3 cents. Why is this important? Well, we can actually see that they raised their dividend 3 cents multiple times, and at one point before this pandemic, they were raising their dividend about twice a year, which means that if they were to have continued, this right here could have been potentially 74 cents of a dividend. This potentially right here could be about 77 cents per dividend. This would be 80 cents here, and of course this has far exceeded what their prior to pandemic dividend increases were. So that tells me that they are right off the top a very stable business right now. In fact, when it comes to the Canadian big six banks, National Bank, CIBC, Royal Bank, Bank of Nova Scotia, BMO, and TD, those six banks have actually continued to pay a dividend and have never decreased their dividend for well over 100 years. That is absolutely insane, and they have been able to go through 2 world wars, multiple different massive stock market crashes, including 2008, 2009, and the most recent one, of course, in 2020, and they are still going very strong with the war that's happening over in Europe. And because of that, this is one of those companies, and actually all 6 of these are one of those companies that you can just invest in and know that if you're looking at a 20-year period or a 30-year period, your money is pretty much safe. They've had 1 missed earnings quarter in the past 4. However, they've had 3 out of 4 blowout quarters. So that is absolutely amazing. When it comes down to their financials, however, obviously 2020 was going to take a hit. However, while their revenue did not, their earnings did. Their revenue was the same as it was in 2019. However, their earnings were much higher in 2019. Moving on to this past year, their revenue absolutely skyrocketed, and their earnings did as well. That is huge in my opinion. I actually kind of predicted that. And if you've been following me for any period of amount of time over the past year, you would have seen about a year ago, maybe a year and a half ago, where I actually mentioned that with these banks cutting back staff and cutting back on how much money that they are spending, that once they start rolling the money back in, getting higher, of course, revenue, that their earnings are going to go through the proverbial roof. And the reason for that is when you cut back on costs, you generally don't want to spend that money again because you know that you don't necessarily have to. And when that is the case and you start getting revenue coming back in, your earnings will go up because you're not spending as much to make that money. The second bank is CIBC. CM is the ticker. And now this one, while it does have a higher dividend than National Bank, it does have also a higher PE ratio. It has a higher average volume, but all of these are going to be well over 1 million shares traded on average every day. So I really wouldn't worry about volume at all. And just to put it out there, I do own 5 out of all 6 of the banks. The only one I do not own is Royal Bank of Canada. However, I do have probably about 80% of my total investments in the Canadian banks. And if we're talking about diversity, it's a very bad idea to do that. However, CIBC is one stock that I did just recently purchase quite a few shares of. Just like most other Canadian banks, they kind of traded sideways doing nothing the years before COVID. And then as soon as the virus hit, this stock went up, mainly because that is when their earnings went up because they were making a killing during this time. Because whenever the government starts printing money, that money has to go somewhere. And when that is the case, the banks are the ones who hold the money. When the banks get the money to hold, they are then able to invest again, which means that they're able to loan out 10 times the amount of dollars that they get brought in, which allows them to make even more money. It's why banks are a fantastic investment when there's a lot of government money spending. It just recently spiked as well, and since then it's been trading sideways for the last couple of months. They also did recently raise their dividend. Obviously, none of the banks in Canada were allowed to raise their dividend during this period of time there, and usually CIBC will raise their dividend usually twice a year. However, there were times in the past that they were raising it every single quarter. As we can see here, 3 cent raise, another 3 cent raise there again, another 3 cent raise there again. Back in 2016, as well as going into 2017, they were generally raising their dividend quite frequently every single quarter, which was absolutely fantastic for those like myself who were investing in their business. When it comes to their earnings and financials, it's kind of an interesting story. Just like all of the other banks, or many of the other banks, quarter 4 of 2021 was not exactly a fantastic time, but they've had 3 other blowout quarters. Also, revenue going through the roof and earnings going up as well. I was really high on Bank of Montreal a few months ago because they made a massive purchase of a bank down in the States. TD just recently did that as well, and I'm really high on TD right now too. However, BMO has a 3.6% dividend and a much higher PE ratio as well than the other banks I just spoke of. Just like all of the other banks, they pretty much traded sideways before the virus, and since the virus, they have exploded to the upside. They also had one of the largest dividend raises after the virus has gone past, and because of that, they were really a sought-after bank for at least a couple of weeks after they announced that dividend. Before the dividend, however, they were raising their dividend, or before the virus, they were raising their dividend about twice a year, and then, of course, the virus hit and nothing happened. BMO was another one of those companies that obviously raised their revenue, got more revenue, made more money in general speaking terms, and in 2021. However, they were one of the few banks who had not great, but a better quarter 4 than the other banks. They've had 4 blowout quarters over the past 4. Bank of Nova Scotia has an even higher PE ratio, but a higher dividend. Now, why is Bank of Nova Scotia kind of a scary one right now? BNS actually has a lot of their business down in the Caribbean as well as over in Europe. And right now, the Caribbean is hurting because there's not much tourism happening. However, that should be returning very soon. While over in Europe, there is, of course, the massive war that's probably going to happen and is already starting. And that could have a negative impact on Bank of Nova Scotia. However, if their PE ratio does drop a bit, which would mean that either they have higher earnings and a lesser stock price rise, then that would still be a very interesting bank to be in right now, because of course there would be a recovery in Europe, and if they started loaning their money to countries like Ukraine as an example, once the war is over, just to rebuild, then that could be a fantastic stock to be in, because of course there's going to have to be massive investments in that country because it's pretty much been leveled. Their average volume is much higher than the other banks I showed you as well. Before the virus, they were actually slightly on the decline, and since the virus is over, in my opinion, their stock price has gone through the roof. They're actually above where they were back in 2017, which is fantastic because it's taken them how many years to recover from that past high. So that's always good. Also, kind of one of the riskiest banks right now, mainly because of their European assets and what's going on over there. However, still an interesting option if you're looking for pure dividend. They had one of the smallest dividend raises to $1 from 90 cents. It was a 10-cent raise. So one of the smallest out of the banks in general. However, they are doing lots of stock buybacks as well, so that is something to really keep an eye on. But again, right now, even though I do own quite a few shares of Bank of Nova Scotia, I would not be investing right now. There are 5 other banks that, in my opinion, have a better option right now for quicker gains. If you were looking over a 20-year period, Bank of Nova Scotia may be potentially a good stock to be in, especially once this whole European fiasco kind of goes away and Russia goes back into their own country. They're not seeing the massive revenue spike then that the other banks are getting. They are getting that earnings spike versus 2020, but it's not super massively succeeding what they did in 2019. So this is obviously something that is troublesome for them right now. However, one of the things I do want to point out is their quarterly earnings. And we all seen that in quarter 4, many of the banks had issues while they did not. Royal Bank of Canada, which is the only stock that I do not hold when it comes to the big 6 banks, RY is their ticker symbol. They have one of the higher PE ratios, which they generally do as well. They're the biggest bank in Canada, which with the purchase of the bank down in the States from TD, technically TD could become one of the largest as well. So Royal Bank, if they want to stay in the top, they probably will be doing some purchases of banks down in the States. Now, I'm not saying that they will, but if they want to be still the number one or biggest bank by assets, then they, or at least for Canadian banks, then they would be looking at potentially buying some American banks or some international banks as well. So look forward to that. They probably will. They have enough money on hand to be able to do something like that. So I wouldn't be surprised if they turned around next month and said, hey, we're buying that bank over there. Their dividend is 3.5% as well, and they do have massive volume too. You'll find that with many of the banks with the higher volume, they'll also have a higher PE ratio, but that's not always the case. They were one of the few banks that were actually increasing their stock price over this time. National Bank was the other one that did that. And since then, their stock price has gone through the roof once again. And this is, again, just because governments were printing so much money. This is what happens when governments print money when it comes to banks. If it's a major bank, they will usually have massive earnings growth because they are, again, able to basically print their own money essentially. And what I mean by that is not how the bank or how the Canadian government does it. How they print money is just basically being able to take $1 in and basically loan it out 10 times over, and that allows them to make an ungodly amount of money. So even though interest rates are sub 1%, they can still make a ton of money. And when interest rates rise, they're going to be able to make even more money again. So these guys have been able to figure out how to make money from the retail banker, which is, of course, from fees as well as ETF fees, mutual fund fees, things like that. They're able to make a ton of money from that. But now with interest rates rising once again, with all of this money that they have loaned out from all the money that the government's printed, I think that any bank really is going to be a great investment over the next couple of years. They also did raise their dividend, and it's not a massive raise like what we would have seen with some of the other banks. However, it's still a pretty solid dividend paying stock. When it comes to their revenue over the past 3 quarters, they have obviously had 2 beats, one being one massive beat there. However, just like all the others, quarter 4 was not very nice to them. They have had revenue growth, however, massive earnings growth at the same time. They basically almost sort of kind of in a way doubled their earnings with not doubling their revenue. So that is very, very promising. And TD, which is my largest holding of them all, has the highest PE ratio, 3.6% dividend. They just made a massive purchase of an American bank. They will be the 6th, once that purchase is through, the 6th largest bank in the United States. And they have ridiculous volume. Now, this one is kind of an interesting one because when it comes to TD, they, of course, did make that massive purchase. It's going to be closed sometime next year, so 2023. When that close happens, because of how large that purchase was, their earnings per share are going to go down and their price to earnings potentially could go down as well because they're going to be having a lot more earnings. So this could be one of those growth stocks that we see because as soon as that purchase is through, they're going to have all of this new revenue that is coming in. And when that is the case, this, in my opinion, could be a fantastic stock to be in. TD is always looking at as more of a growth name over the past couple of years anyways, and it just seems that with this newest purchase, because they were already expanding down in the United States, really shows to me that they have a lot of faith in the American market and want to expand. Their dividend would obviously go up too because when they get more earnings coming in, their dividend is obviously going to be going up. Now, if we cut out what has happened earlier on in 2017, the stock was going sideways. If you include what happened earlier on in 2017, then yes, they were a bank that had their stock price rise. However, if we cut out that part and we look at what happened when the virus hit, it basically stayed stagnated for a while, and of course, it actually rose quite a bit since then. This is a massive raise. Like, imagine if you were like me and you were purchasing the stock there, or when I bought more, roughly at that point right there. I didn't buy it at those lows. I bought more at that point right there, and at first I was thinking I should have waited, which I should have, but I didn't. But it has raised since then. Again, massive dividend raise when it comes to the dividend since they have been able to raise their dividend. However, they have had 4 fantastic quarters. The most recent one has been kind of scary, but 4 good quarters, massive earnings growth, good earnings growth, fantastic stock. Now, out of the 6 banks, which one would I recommend? Well, first off, I really like CIBC, but also I really like National Bank as well because of their PE ratio and their dividend. Now, of course, National Bank has one of the lower dividends out of them all. However, if we look at CIBC, it has the second lowest PE ratio and one of the highest dividends. And when I look at that, CIBC would be number 1 on my list right now. And in fact, I just recently purchased a lot of shares of CIBC as well. Now, when it comes to these stocks, you can't go wrong. You can buy any of them and you would be totally fine in most cases. However, Scotiabank being the most riskiest one in my opinion, and TD is a fantastic growth opportunity because they just made that massive purchase down in the States. But if you look at just the overall top view of CIBC, it's historically what I chase, which is the Canadian banks that has the lowest PE ratio, which is the second lowest, and it has one of the highest dividends that out of the big 6 banks. That is exactly what I personally look for when I buy the banks, and I buy an absolute ungodly amount of Canadian banks. It's like literally 80% of my portfolio. That's why I don't really share my portfolio on that much on this channel because it's basically just banks. I have a lot of small investments here and there, but it's mostly banks. And yes, I should be more diverse, but I just really like and I really understand the business model of the banks, and I really like them. Anyways, remember to do your own research. Never trust a random person on the internet. Because of all of these comments and things like that about Bitcoin, watch out for those too. But also make sure to consult a professional accountant or a professional banker before you make any decisions that you may not fully understand. I hope that you've enjoyed today's video. If you have, hit that like button, subscribe, and I'll see you guys again next time.